Hello, my good people. I hope that you are all fine. And today we are going to talk about conversion of partnership to company, to limited company. This is financial reporting, and specifically this is lesson one on conversion of partnership to limited company. So welcome. We shall do several questions, then we finish the class. So thank you. So let us start. So let us start. Let us start. So during conversion, this is what you need to know. So this you need to know that during conversion, so we say uh, during conversion, no accounting standard is required. No accounting standard is required. So conversion of partnership to limited company, during conversion, we are not required to use any accounting standard during conversion. So that's why we are saying during conversion, no accounting standard is required to be followed. To convert company, to convert partnership to limited company, to convert partnership to limited company. Number two, the only thing that you need here is the concept of double entry. So you need to know how to do the double entry system. For every debit, for every corresponding debit must have a corresponding credit entry. So any debit entry must have a debit entry. So double entry rule is required. Double entry rule is the only rule needed during conversion. During conversion of partnership to limited company, to limited company. That's the only rule that you need, the double entry rule. There's nothing else. Now, you need to know that during conversion of partnership, the books of account of the partners must be closed, and then we open the books of account of the company. So you need to know that one, that during conversion, books of accounts of partnership must be closed. And books of account of the company must be opened. Books of account of company must be opened. So we close all the books of account of the partnership, then we open the required books of account of a company. Let's say account to be closed in accounts to be closed. Accounts of partnership to be closed. Number one, we need to close what we call the appropriation account of the partnership. Appropriation account. Number two, in that order, I'm going with an order. The order that I'll be using when doing a question. So appropriation account. Number 2, current account. Current account. Number 3, realization account. Realization account. Number 4, partners capital account. Partners capital. Partners capital account. That's all. Now you need to check this one. Check on the following item. Check on the following item even before you start doing a question. So check on the following item. Number 1, even before you start doing a question, check on the following item. Number 1, the conversion. If the conversion occurred at the beginning or during the period. So before even you start a question, make sure you check. You try to check, when did this conversion occur? Was it at the beginning or during the period? So that your portion were necessary. Number two, does the question have net profit? Does the question has net profit? Now, if yes, start from the appropriation account. If yes, start from the appropriation account. Start from the appropriation account. If no, prepare the net profit. The net profit to continue from the appropriation account. From appropriation account. And you know how to prepare the net profit. I hope you know how to prepare the net profit from your previous level. So I'm not going to explain that one, how to prepare the net profit. Maybe we shall do, when we do a question, we shall check. But for you to prepare the net profit, remember you start from the sales, less cost of sales, then you add any income if there is, then you less all the expenses, then you get your net profit. I'm not going to explain everything because already you have it in your, So let us do this question for November. So we start with a simple question. November 2019, question number 1B. November 2019, question number 1, boy. November 2019. The question is question number 1, boy. Question number 1, boy. So let us see this question together. Let us see this question together. So the question is for November 2019, question number 1, boy. November 2019, question number 1, boy. Let me read it. Now, Chanda, Pete, and Tender have been partners in a business for many years, sharing a profit or loss ratio to 2:1. So let us write it down. So we have, I will call them the Chanda, Pete, and Tender. So CPT. Let me call them CPT. So we have Chanda, Pete, and Tender. Their ratio is 2:1. 2:1. On 30th June. Now you need to check when is financial statement starting. Our financial statement ends on 30th June. 30th June. So if we draw just a small one here, our statement ends in 30th June. So June ni mwezi wa sita. Mwezi wa sita. June 2019, meaning it is starting on 1st July 2018. So that is a financial year starting. Now let us go back to the upper part. So on 30th June 2019, that is the partner converted the company into limited company to be named Chapete Limited. So on 30th June 2019, so it was at the end of the year. So it was converted at the end of the year. So meaning it's at the beginning of the year 2019 going forward. So it was converted at the end of the year. So that is okay. So it's not within the period. So that we have identified that one. So you have been provided with the trial balance there. So you have the trial balance. Then additional information number one, property, plant and equipment in partnership were being depreciated as follows. So let's start with the depreciation information number one. So working one. So let's start with the depreciation of building. Depreciation of building. Now the building was depreciated at the rate of 2%. 2%. Remember it's on straight line basis, so it's on cost. So straight line basis, that is on cost. So we go to find the cost of building. Now building cost is 50 million, so it is 50 million. So we put it in thousand. So we're going to put our items in thousand. So 50,000. So 2% of 50,000 is Kenya shillings 1 million. 1 million. So in thousand, so 1,000. We go to the depreciation of number two. Still an information number one, depreciation of plant and equipment. Depreciation of plant and equipment. It is how much? 12.5%. 12.5% times the value of the plant. So plant and equipment, let's go back. Plant and equipment, 25,000. So it is, so 25,000. No, but remember, that one was on reducing basis. Now, on reducing basis means we need to less the accumulated depreciation. So on reducing, we need to less the accumulated depreciation of plant and equipment. In our trial balance is 13,000. It is 13,000. When you multiply, you get 1,500. You get 1,500. Then depreciation of motor vehicle. Depreciation of motor vehicle. Information number one still. Motor vehicle was depreciated at the rate of 20% on straight line basis. 20% on straight line basis. Let us go to that one is on cost. So straight line basis, that is on cost. Motor vehicle cost is 25,000. 25,000. That one will give us around 20 motor vehicle. Let us check our motor vehicle first. Let us go check for another additional information. We see if there is anything. Motor vehicle. Where is that motor vehicle? It is supposed to be 12,000, not 25. It's supposed to be 12,000. That will become 2,400. 2,400. Then we are remaining additional information number one. We are remaining with fixtures and furniture. Fixtures and furniture. Fixtures and furniture. Fixtures and furniture. 10%. Now it is on a straight line basis, so that one goes with the cost. Straight line basis goes with the cost. Furniture and fitting, which is 4,000. That will be equal to what? 400. So those are values of our depreciations. You can see there. Then let's go to information number one. Property cost was 60 million. Now property cost, including building. Remember building, when they were told us building is 50 equals to 60 million. Now what does it mean? Now this was supposed to be 50 million because it is in thousand. Remember the items are in thousand. Our question is in thousand. So now meaning the remaining 10 represent land. So land is 10 million. So you need to know that land. So that is still information number one. That land is 10 million. Now let's go to the next item. The next item is information number two. Depreciation. The partners were entitled to an interest on fixed capital of 20% per annum. So interest on capital, fixed capital. So we have CPT, each 10% of their capital, each 10% of their capital. Let's see their capital. So let's go to our total balance and look for the capital account. Now, Chanda is 30,000. 30,000 capital account, 20,000, 30, 20, and 10. So that you will get 3,000, 2,000, and 1,000. So we have done with capital account. I think now we can open, before we continue, we can open the realization account. Remember we said we need to open the realization account. I think I can use a different pen. The realization account, let me use a different pen. Realization account. Realization account. Now, the purpose of opening the realization account is to write off the assets. The realization account. Now, realization account, we need to write off all the assets. Let's go to the information number two. Number three. The non-tangible assets were transferred to the company account at the fair value as follows. Now that one will represent the item that will go to the settlement of the financial position for the company. But we need to write off our asset as on the net book value. So when we write our asset off, we shall write them at their net book value. So all the assets and their ability, all the assets and liabilities must be written off. They must be written off at their net book value. They must be written off at their net book value. So let's go and look for all our assets in our draw balance. Let's start with the first one. Plant and building. So we have plant and building. Now, plant and building, the cost was 60 million, including the land. The cost was 60 million, including the land. Now, we had a depreciation of building of 1,000. And also, don't forget, because it's on cost, don't forget to rest the accumulated depreciation for building, which is 5,000. So how much would that be? So 60,000 minus 5, you 55. So it will be 5,400. 54,000. Next, after that, we have our plant equipment. So what was the cost? Plant equipment, the cost was 25,000. Minus the plant, the depreciation was 1,500. And because it is on cost, we need to raise the accumulated depreciation. So the accumulated depreciation means the provincial of plant and equipment is 13,000. 13,000. So remember, under your financial accounting, we said this. So you need to remember that when we were doing financial accounting, we said that provincial for depreciation is the same as in the total balance. Provincial for depreciation is the same as this is the same as saying the accumulated depreciation. So remember, the one provision for depreciation in our total balance is the same as saying accumulated depreciation. So don't worry where we are getting the accumulated. The accumulated is the provision for depreciation. That is 13,000. So the 25,000 minus 15,000 minus 13,000 is approximately 10,500. 10,500. Then we have next after plant, we have the motor vehicle. Motor vehicle. Motor vehicle. Now motor vehicle, the cost was 12,000. We less the depreciation of motor vehicle, which is 2,400. Then you are supposed to less the accumulated depreciation, which is 4,800. 4,800. So how much would that be? It will be equal to 4,800 also. So that will be the net book value. That remember, for you to get the net book value, maybe I had it explained, is equals to cost minus the accumulated depreciation. But remember, the depreciation for the year, this one, was never accounted for. They said somewhere that the depreciation for the year was not accounted for. That's why we are raising now even the depreciation for the year, because it was not included in the accumulated depreciation. So, or if you want to know, anything in the additional information is not included in the total balance. So you need to know that one. Anything in the additional information, anything in the additional information is not included in the total balance. That's why we are lessing the accumulated depreciation and also lessing the depreciation for the year, because it is in the additional information, meaning it was never included in the total balance. Next, after motor vehicle, we have the furnitures. Furnitures and fittings. Now, furnitures and fitting, the cost was 4,000. We less the provincial for furniture, which is 1,600. 1,600 minus 400. The 400 is here, so that we get 2,000. 2,000. The next asset from that one, from the non-current, we go to the current assets. We have trade receivables. Trade receivables. So I will just call it receivables. So receivables from the question is 18,200. We also have inventory. Inventory 25,300. We also have cash, all those assets. So we also have cash. We also have cash. Sorry, cash. It's supposed to be 25,300. Which other assets? Oh, cash. I've said we have cash. 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 Cash is how much? Cash is 8120. Now, once we have those one, so all the asset will be debited in the relation account for them to be written off. So all the assets will be. So remember, for assets, when we acquire an asset, we debit that account. Sivyo. Now, if you want to close this account, we must debit the balance. The balancing figure will be credited. So if we credit the asset by writing it off, then it means if we transfer it to the relation account, if we credit by writing off, we need to debit it. Now, for liability, is the opposite. So if you have a liability, we debit. But if you want to write this account off, we also, if we have a liability, we debit. But if you want to write it off, we sorry, if we have a liability, we credit it in our account. But if you want to write it off, we debit. Now, if we debit our account by writing it off of liability, if we transfer it to the relation account, what do? If we credit it, now we are supposed to debit the account. So let us start with the first one. But you need to know that when we are writing off the assets, we debit the relation account, and when we are writing off the liabilities, we credit the relation account. So let us start with the first one. Payables was the common one. Payables of how much? 14,700 in our trial balance. Then we had a bank loan. Bank loan. So the bank loan of 18,000 and any other liability. So we only had those two liabilities. Then you need to remember something else. We need to put purchase consideration. So purchase consideration, because they acquired the assets of the company, of the partnership. So how much did they pay to acquire this partnership? So let us see how much did they pay. The purchase consideration, information number 5. That is information number 5. You need to check for the purchase consideration. The purchase consideration amount to 110 million. 110 million. So it is in thousand. So 110. So remember, this account is also in thousand. Don't forget that this account is also in thousand. Now we need to balance this account. Now the balancing figure can either be a gain or a loss. A gain will be on the debit side. A loss will be on the credit side. Then we share to the partners. So we need to balance this account. So let us balance this account. So when you add this item and this item, so this item will be more. So when you add this item, it will give us around 142,700. So when you add this plus this plus this, 142,700, which is more than this account, meaning our balancing figure is on this side, so we share. So when it is on this side, we share according to the partner. So we share to partners the balancing figure. So we had CPT, C, P, and T. I hope it will allow I will manage to compress and okay, let us see if it will allow to. I don't know if the screen is visible at that point. Yes, it is fine. That is okay. So let us balance this account. So we have said it is when we add this 142,700, 142,700, 142,700. Now, so let us allocate. So if you find the balancing figure, so C, P, and T. So we share according to the ratio. So C 2 is 1. That is 2 over 5. So this one will get 2 over 5, 2 over 5, and 2 over 5. So how much is that? The balancing figure, it is 19,780. 19,780, 19,780, 19,780. So that the account balances. So let us see. So 2 over 5 times 19,780. 2 over 5 times 19,780 is 79,12. 79,12. 79,12. and the last one is 3956. So that's how you prepare the realization account. That's how you prepare the realization account. And remember, this account is there just to help you come up with the share that will be transferred to the partners what? Partners capital account. Partners capital account. So let's go to the next item. Our next item to prepare now is the current account, partners current account. And before we prepare the partners current account, we need to prepare the appropriation account. So we need to prepare the appropriation account. So that format, make sure you use that format. So because of space, I'm going to compress this item here. So we say CPT, appropriation account, CPT, appropriation account, for the year ended, for the year ended, 30th 6 2019. Now there's something that was not adjusted, which was on additional information. Now let's go to our question there. We have our net profit for the year. So we start with the net profit for the year. It is in thousand. So net profit for the year. Net profit for the year. Net profit for the year. So net profit for the year is what? 28 800. 28 800. Then we adjust. Now we adjust by lessing the depreciation. So that says the depreciation, we add all the depreciation. This one, this one, this one, this one, we add them together because it was never deducted. It was never deducted. It was never deducted. So it was never deducted. So we added them together. So 1000 plus 1500 plus 2400 plus 400. That brings us to amount of 5,300. So we need to deduct that one first. 5,300. So that we get the actual profit. Our actual net profit, how much will that be? 28,800 minus answer. That will be equal to 23,500. Then we share. So we share first according to what? Before we share, we less interest on capital. On the fixed capital, we had computed it. So C, P, and T. So we have it here. 3,000, 2,000, 1,000. So we had 3,000, 2,000, and 1,000. There was no any other account in that case. There was no any drawings or whatever. So that we get, so 23,500 minus 3,000 minus 2,000 minus 1,000. 17,500. Then we share the profit. We share to partners the profit. So CPT. So we share according to their ratio. So 2/5, 2/5, 1/5. 17,500, 17,500, 17,500. So 2/5 times 17,500 is only 7,000. So we are not at 7,000. Or how much? 2/5 times 17. Yes, after we get paid at 7,000, which is the same amount. And then kuna huu moja 3,500. so that we have a nil balance. So all the item has been shared. So that's our appropriation account. That is our appropriation account. So let us open out the partners account. Partners account. So the partners account, we shall prepare specifically partners current account first. Partners current account. So partners current account. So I hope I will compress a bit. So we have the details. So we have C, P, and T. Then details. C, P, and T. Then that one is enough. CP and T. CP and T. Just a moment. CP and T. CP and T. CP and T. So so we start with the balances from the partners for the current account. So balance brought down. Balance brought down. Now the balance brought down from the partners, we can see is 4280, that 560 and 23 what 40. So we have 4280. Remember it is in thousand. 4280, that 560 2340. Then interest on capital. Interest on capital. So interest on capital, we have 3,000, 2,000, 1,000. 3,000, 2,000, and 1,000. Interest on capital. Then we do the then we share this one, share of profit from the realization. Share of profit from the realization. We need to do this one. Share of profit from the realization. So we do share of profit. Share of profits. That one just as and then into bracket R, so that it's from the realization. So we have 7912, 7912, 7912, and the other one is 3956. 3956. That one is from the realization. This one is from the realization. 3956. Now, once we have that one, there's no any other account. We don't have goodwill or whatever. So meaning this account can be closed from this end. Can be closed from this end. And also from the other end. So this account can be closed from this end. So we don't have any other account affecting the debit side of the goodwill, because we don't have anything else like drawings. We don't have drawings. So meaning the balance goes to the, so this will be the balance figure to the capital account. So this balance will go to the capital account. So let us compute how much is that. So 2340 plus 1,000 plus 3956, that is 79. 2340 plus 1,000 plus the last one is supposed to be the last one. Just a moment. Sorry, we have done a mistake here. This one is supposed to be for appropriation account. Supposed to be the appropriation because the share of profit. So it's supposed to be appropriation account. So be very keen. Not the realization. Realization will go to the capital. So the current is supposed to be the profit. This one. Not this one. So don't pick this one. 7912, 7912, 956. No. It's supposed to be 7,000, 7,035. So that when we add them together, where's my calculator? It's supposed to be that 2340 plus 1,000 plus 3,500. That is 6840. 6840. 6840. 12,560. 12,560. And the other one is 14 to 80. 14 to 80. Same on this side. 14 to 80. 14 to 80. Not 14, rather. 12,560. Then this one is 6840. Now the balancing figure is now 14 to 80. 12,560. And then 68. 6840. Now, having done that, now we can prepare the partner's capital account. Partner's capital account. Partner's capital account. Capital account. So let us prepare partner's capital account. So we have details. So we have C, P, and T, CPT, then details. So C, P, and T. So we start with the balance brought down. Balance brought down from the total balance. So let's go to our total balance. So the capital account as 30, 20, and 10. 30,000, 30,000, 20,000, and 10,000. Then realization account. So share of realization. So let me call it the realization. So realization, we have it here 7912, 7912, 7912, 3956, 3956. That's the realization account. Then current account, this one to capital account. We say to the capital account. So from capital account, so let us just call it current account. Current account 14 to 80, 12,560, 6840. There's nothing else on that side. Now we don't have even goodwill, so meaning we balance this account from this point. You also balance it from the other side. So we add them together. So 10,000 plus 3956 plus plus what? We have made a small error. I don't know why I did not see this one. We had drawings. So there was drawings actually. Just a small error. Just a small error. We had drawings here. So meaning our figure would change a bit. So we had drawings actually. So you need to be very keen. Drawings in our total balance is the last item in our total balance. We have 1580, 1580, 1780, 1580, 1170, supposed to be 1170, 1170, and 710. So that we go to the capital account. So to capital account. So make sure you remember these things from financial accounting. So 12,700, 12,700. The other one will be 11,390. So it will be 6130. So we transfer it to the other side. So to capital account, 12,700, 11,390, 6130. 6130. Now we find the total. So when you take 10,000 plus 3956 plus 6130, we get 20,086. 20,086. 20,000 plus 7912 plus 11,390, we get 39,302. 39,302. Then the last one, 30,000 plus 7912 plus 12 plus 7912 plus 12,700, we get 50,612. So on this side also 50,612, 39,302, and the other one is 20,086. Now let us find the balancing figure. The balancing figure to the capital account, to the company as share capital. To company as share capital. There's no any account which is affect the partners capital account on the credit, on the debit side. There's no any other account in that case. So that will be the balancing figure: 50,612, 39,302, 20,086. When you add these three items, it must be the same as this purchase consideration. You see this purchase consideration of 110,000 is supposed to be the same as 50,612 plus 39,302 plus 20,286. It's the same as the purchase. This one is the same as the purchase consideration. It's the same as the purchase consideration. Is the same as the purchase consideration. So let's go to the requirement. Requirement number one, we're supposed to prepare the relation account. Here is it. Number two, we are supposed to open the capital account. Here it is. And number three, now we are supposed to determine the opening statement of the statement of the financial position as at 1st July 2019, as at the beginning of that year. As at the beginning of that year. Now, before we do that one, we need to open cash account. Cash account and company account. So let us start with the company account. Then we open the cash account. So Chapete Limited company account. We say Chapete Limited company account. Now this one we get to company account. The share, so we have C, P, and T. So we have it here: 50,612, 39,002, 20,086. it will give us 110,000. Then the balancing figure will be our purchase consideration of 110,000. Then the cash account, start with the balance at the beginning. Balance brought down, it was how much? For cash, the balance was 8120 from the top balance. 8120. Let us see. There was an issue of shares. That is money in of 110,000. Information number 5. Let's go to information number 5. Information number 5. The purchase consideration amounted to 110,000 and was settled by a new company through the issue of shares. So there was an issue of shares at shillings 10. That is, it will give us 110,000. For the certification upon conversion. Now, this issue was to pay conversion. How much did they pay? 110,000. So they were to pay. So that amount was there specifically to pay the accounts, to pay the partners. And then there was nothing else. There was nothing else concerning this account. So we find the balance card down. So at the end, it will be the same amount. So at the end, I think it will be the same at 118, 120. 118, 120. So our balancing figure will be equal to 8120. That is okay. Now once we have the cash, now we can open. So this is the opening balance for the opening balance for that year. Now we can now open now the statement of the financial position, the opening statement. The opening statement of the financial position. I do it here and it will be faster. So let us say Chapeta Limited. Chapeta Limited. Opening statement. Opening statement of financial position. Of financial position. As at 1st July 2019. The amount is in thousand. So we start with the non-current asset. Non-current asset. The first one is property. So information number 3. The property acquired was 57,000. 57,000. Plant and equipment. Plant and equipment. Plant and equipment acquired was how much? 16,000. 16,000. Then you have motor vehicle. Motor vehicle acquired was for how much? 9,500. 9,500. Furniture and fitting. Furniture and fitting. How much for furniture and fitting? Furniture and fitting is 3,500. Then you need to add something else. Goodwill. This one requires a working. Goodwill requires a working. So then we go to current assets. Our current assets, inventory. Now in inventory, what they are saying, information number 4, the current assets and liabilities were taken over by the company on their net book value. So all the current assets and current liabilities were taken over on their net book value. So what was the net book value? The yapa. It was an receivables. How much was an inventory? 25,300. 25,300. Inventory also acquired on the net book value. This one is receivables. Sorry, receivables. Receivables is 18,200. We have cash. Cash is 81 day, 8120. So that we get our total assets. So we get our total assets. Get our total assets. Then equity and liability, because now it's a company, we have equity and liabilities. So the first one, we had an issue of shares of 110,000. So that's the ordinary share capital. And it was paid. So it was already paid. They paid how much? 110,000 to acquire that assets. Okay. Then we have non-current assets. There is non-current liability, sorry. And that is the bank loan. So we have a bank loan. They said it will be acquired on our net book value. That is from as per the balance sheet. 18,000. Then we had current liabilities. Current liabilities. And the only current liabilities that were acquired on the net book value was payables, because this one was still on the net book value. Remember, the realization account. The realization account is prepared on the net book value. How much? 14,700. 14,700. So this one you can get our total equity and liability. Total equity and liabilities. And liabilities. So when we add this together, 110 plus 18 plus 14, it's supposed to be 142. 700. Supposed to be 142. 700. 142. 700. So this one is supposed to be 142. 700. Now we need to get the goodwill. So let's compute goodwill. Now remember, for you to get the goodwill is equal to purchase consideration minus the net asset. And you remember net asset is equal to total assets minus total liabilities. So make a net asset is equal to total asset minus total liability. So let us start. So goodwill will be equal to our purchase consideration. We have it here. It was 110,000. Now we are supposed to less total assets. Total assets. Goodwill not included. Remember, goodwill not included. So you need to add them together. So 57,000 plus 16,000 plus 9,500 plus 3,500 plus 25,300 plus 18,200 plus 81,20 to give us 137,620. 137,620 minus total liabilities. So remember, this one is not a liability. So it is 18,000 only plus 14,700. 32,700. So we shall get a figure. So 110,000 minus 137,620 minus 32,700. 50,80. So meaning the figure here is 50. 58. I don't know if that is the correct amount. But if that is the correct amount, it must balance. But if that is the correct amount, then it must balance. So that one marks the end of the partnership capital account. When we meet, we shall do another question for 2024. So when we meet, we shall meet and do another question. And that question will be specifically for the year 2024. So important things that you need to remember is to prepare the appropriation account, partners account, and current account. So those are the most important items.